Hello, my name is Steve Bigelow with the Candlestick Forum. The markets is still in a kind of an indecisive trading stage. Today we saw the Dow sell off, came right back down, smack dab to the 34 EMA, which works relatively effectively on candlestick charts. Notice how when it hit it, it came back up and did a Doji type day. At the same time, the NASDAQ as well as the S&P 500 also came back down to the T line and bounced back up and closed near the high end of the trading range. Not only staying above the T line, but staying above the 3T line. Remember, the assumption is as long as we're trading above the T line, it has to be assumed that the uptrend remains in progress. Continue to watch to make sure we're staying above the T line with the expectation if they break out through this level, wave 3 of a J-hook pattern's in progress, which implies more upside in this market. So here's an important reason why long-term holds may not be as relevant anymore as they were in years past, because there's new dynamics that come into different sectors. Today, Apple announced that they should have their electric car out on the market by 2025. It closed at an all-time high, with the implication there's going to be a lot more upside. Now, that new information obviously will affect other charts. We don't know which ones, but the charts themselves will tell us which ones are being affected the best or the most. Fuel cell apparently is not going to react well to Apple's entry in the electric vehicle sector. This is also identified by a bearish left-right combo, a bearish double doji sandwich. Not a place to be long. These are the patterns we're trying to find. This is why knowing what the 12 major signals and what the candlestick signals and patterns illustrate, you can see the fry pan bottom on Jewel doing this type of move. Why? Because that's investor sentiment buildup. This is the expectation. That's why we recommend fry pan bottoms, like in our recommendation of MCRB, fry pan bottom. What's our probability factor? If it moves out, it's going to be a big price move. Why are patterns better acclimated for investing? One, because they aren't quick turnaround situations. This is a buildup of investor sentiment, and when it breaks out, it's because that investor sentiment started getting enthusiastic. It also protects from a major market turn that a fry pan bottom is usually still going to work effectively, because it's not a one-time reversal signal. It's a buildup of investor sentiment. The strong candlestick signals, such as your bearish best friend, provide that information that tells us there's going to be a strong downtrend. Well, that's how we base our recommendations, not based upon fundamentals, but what is going on in investor sentiment. When we recommended going short on PAG, it's 2+2 analysis. You've got a bearish best friend breaking this uptrend. Today it did a doji day. What do we know about a doji? The price will usually move in the direction of how they open after a doji. This becomes a very viable short if it opens lower, the doji rule, which is then reinforcing the bearish best friend signal, giving you high probabilities of your next target being much lower. This is not rocket science. As long as we can identify a pattern, we can use the T line as a support. We can see there's a breakout level right here. So just simple 2+2 analysis says, if this is wave 1 and we see wave 3 starting, it's going to go through this resistance level, which everybody else will be watching. This allows candlestick investors to be buying here with great confidence when everybody else sees that it's broken out trading much higher. So tomorrow will be important to see how the Doji rule simplifies our trend analysis. The price will usually move in the direction of how they open after a Doji. If it opens positive, tells us we may still have a J-hook pattern setting up. If it opens lower, it's telling us this move is still backing off. That'll be it. We'll see you in the chat rooms.